All right, we are in the thick of earnings season. 170 S&P 500 companies reporting results this week, according to FactSet, and the headliners after the close, Amazon and Apple. We're watching those closely. Joining us now is Laffer Tengler, investment CEO and CIO, Nancy Tengler. Nancy, thanks so much for joining us. So let's kind of dive right into the key focus for today amid this earnings season. I mean, you've had about 80% of companies beating expectations. You have these two kind of bellwether companies, if you will, especially Apple. I mean, they've made up, as Jared Blickery just pointed out, a significant portion of the rally that we've seen. What does Apple or Amazon need to deliver, and pardon the pun, to not upset the apple cart, if you will?
Oh, boy. Thanks, Diane. That was an excellent pun. So I think that a couple of things. I think they have to provide strong guidance as we move forward. And there has to be at least a maintenance of or expansion of margins. What we've seen this last quarter is, I find it just amazing that almost every quarter, 80% of the companies surprised to the upside. But this quarter is particularly important because expectations were so low. So what we've seen, and I think this comes from the fact that managements have been waiting for the Godot recession now for almost a year, and they've had time to prepare. So they've laid off staff, they've cut costs, they've improved supply chains. We saw that with Starbucks in the most recent report. And so what we really want to hear from these companies is that they are going to continue to deliver on margin, and they are providing positive guidance as we look forward.
Yeah, and Nancy, on that front, we've been following a lot of these consumer-facing companies. Apple's certainly one of those, Amazon another one. And the commentary seems to be that, yes, the consumer is still very resilient, but they are starting to get a little more cautious. And I imagine we're likely to see that reflected in Apple numbers as well. But what's your read on what we've heard from the companies as well? And to what extent that is indicative of what we're seeing in the broader macro
So, Kiko, we were advocating and we were following our own advice by adding to technology and consumer discretionary last fall. It seemed to us that we were closer to the end than to the beginning of the rate hiking cycle. No big surprise there. And that inflation had peaked in June and was coming down. And so we added risk back into our portfolio. Those are also the names we've been trimming in recent months because they've run so far, so fast. But if you step away and just look at Starbucks as a bellwether for the consumer, what you'll see is that they saw increased engagement on the digital side of their business. So 75 million users, 4 million new from a digital 90-day kind of average user, saw 20 million peak. It's a peak number in China. And they raised guidance on revenues and earnings, revenues from 10 to 12%, earnings from 15 to 20. So I think what we're seeing is that the consumer is still spending in areas where they find value or they find satisfaction. You saw today in the ISM services numbers that prices paid came in at 56, which is well above expansionary levels. So I think you have to go company by company. You have to own the high quality companies with the proven management teams that can continue to deliver earnings growth in a slowing economic environment. And that's what we've been focused on in our portfolios.
Nancy, let's talk about those margins that you mentioned. What do you see enough improvement in terms of inflation at the wholesale level for companies to improve their margins?
Yeah, exactly, Diane. I mean, what you saw in this inflation cycle was that PPI peaked in March, CPI peaked last June. And now we're in an environment where PPI is down to like 0.1%. It has been leading inflation down, and companies have been taking advantage of that by maintaining margins. So they've been able to pull back a little bit on pricing, though some companies were still seeing pretty aggressive price increases. But in general, what you're seeing is that managements have been able to manage that. And I also thought today's productivity numbers were pretty encouraging. They're notoriously volatile, so I don't want to read too much into this, but productivity came in much stronger than expected. Unit labor costs at about a positive 1.6% for the last quarter. We can live with that. I think the Fed can live with that. So we'll be continuing to watch throughout the season, but we're seeing a common theme among the higher quality names that we own.
Nancy, let's talk about the broader market action. We've seen the S&P 500 edging lower for a second day. This coming after the big sell-off we saw yesterday on the back of the U.S. credit being downgraded by Fitch. You say we're still in a bull market, but where do you see the opportunity to invest right now?
Well, I think Akiko, that you want to own companies that can deliver earnings growth when you're in a slowing economic environment. And I don't know if we're going to get a hard, soft, no landing, but I do know the trend, and that is that growth is slowing. The government, and this is, I think, Fitch's downgrade matters only because it drew attention to the fact that the government is sucking capital out of the private sector in an unprecedented manner that in my career of 40 years. So we will see slowing growth despite the spending that has been coming out of Washington. And that's when you want to own the companies that can deliver growth. So think the technology companies, that the large cap names, the established names, the ones that are going to benefit from the AI tailwind, the cloud tailwind, the digital tailwind. And then our other theme is old economy companies that are embracing the digital revolution. So this would be a name like Starbucks, but there are plenty others in our portfolios, a number of industrials that are really turning into technology companies, if you will, or even a Pepsi who says we are a technology company that happens to sell snacks and beverages. And so those are the names that we want to own with strong management teams that will deliver through this period. If you get a dividend and a rising dividend, that's even better. But this is not the time where you want to go uber defensive and own the highest yielding names in the S&P. You want to own dividend growers that are able to also support their earnings growth.
So, Nancy, I want to put a pin in that because I definitely want to come back to that conversation about particular stocks that you like. But I just want to get your perspective, especially while we have you now. We talked to a lot of economists fresh off the heels of that downgrade. A lot of people were surprised by it, not so much by, I guess, it happening, but the why now? What was your take, or what is your take on that downgrade?
I mean, I think it's late. To be honest, I think they're trying to get in front of the presidential election, so they're not implementing a downgrade during a presidential election year. But I think what we all know is that about half of the U.S. Treasury, the debt is going to come due in the next 1 to 3 years. That half is at an average coupon of about 1.6%. So you didn't really have to be super good at math to understand that debt servicing is going to go up dramatically. We think it's somewhere between $250 and $400 billion this year. And that is just simply not sustainable. And so I think that's Fitch's message, which is the spending needs to come in. I don't know that it will, but it's drawing attention to it. I think that's good. But other than that, I don't think it's very meaningful.
Mm-hmm. All right. Go ahead, Akiko.
Yeah, Nancy, we've been talking about where the economy is headed. It feels like we've been having this potential recession conversation for more than a year. Expectations for that have started to recede, while inflation easing has given some sign of optimism for investors. But there is a question of a soft landing. Where do you see that going right now?
So I just wrote a piece called The Perfect But Not Necessarily Soft Landing, because I'm up in Tahoe and I landed a perfect faceplant on a granite slab recently. And so it just was mindful of the economy. If you land it just right, I was able to protect the rest of my face by using my nose as an airbag, according to the doctor. But I think that you have to, as an investor, understand the trend line. And what the market's not anticipating. I do think that we might have an uptick in inflation between now and the end of the year, and the market's definitely not pricing that in. I would use that as an opportunity to step in and buy the higher quality names that will go on sale with everything else during that correction period. But that's just a speculation. I don't know that that's going to happen. I think, however, that what we're seeing is companies are raising earnings estimates. So the hard landing scenario, in my view, is out. The soft landing or no landing are more likely. And again, all I need to know as an investor is that growth is slowing, and that allows me to allocate my portfolio accordingly.
And Nancy, speaking of that soft landing scenario, let me just give some context to where I want to go with this. So Bank of America dropped their call for a recession this year. Do you agree with that assessment? And is a soft landing, in your eyes, no recession?
Pretty much, Diane. I mean, answering the latter part of your question, I think a soft landing is kind of no recession, at least one that won't be widely felt. I think that I don't want to sound cynical, but I think following the strategists is never a winning strategy for investors who are trying to buy low and sell high. So many of these same strategists were extremely negative last year when you actually should have been holding on to and adding to your equity holdings. And so I think now it's just a little bit too late, too little, too late. They may be right, but the market's already reflecting that. The market already discounted at least an extension to the recession last fall and into the first half of this year. So now we're looking forward and saying earnings estimates are on the rise in the first half of this year. They're going to be much stronger next year. And that's really what the market's focused on, rather than do we or don't we actually, have a soft landing or no recession at all.